Hello everyone, and welcome back. My name is Arias, and today we're going to be talking about Teladoc. I'll break down what they do, the recent acquisitions, especially Livongo, their long-term addressable market, the risks, and we'll project their revenue out to 2031, and value them based off that. I'll also get into my position in this stock and whether I'm buying more now. Don't forget to like and subscribe if you enjoy this type of content, and don't be afraid to leave any feedback or video ideas in the comments below. And without further ado, let's get into it. Let's start out by explaining what Teladoc does. They have three main service categories. First, and as you probably already understand, Teladoc provides telehealth services to consumers. These services are often paid by employers on a per member per month basis, but can also be paid by the visit directly by consumers. To provide these services, they operate a complex platform that connects patients with doctors, which both have to be in the same state or province as each other for regulatory reasons. This is an extremely delicate task to match doctors on the network with patients who need care in a timely manner, and this is part of what sets Teladoc apart, as they already have achieved scale to provide timely care at all hours of the day. The core value here to the patients is they can get care on demand wherever they are without having to go to the ER or a walk-in clinic, and they are willing to pay for this convenience. Doctors also derive value from being on the network, as they can earn extra money in what would have otherwise been downtime waiting for the next appointment. The second offering is using their platform to allow patients to see specialists, sometimes even while they are already in the hospital, to take better care of their symptoms and get a second opinion. This enables better care because patients can get a second and perhaps more expert opinion quickly. The last and most important category is their long-term care services that they provide through Livongo. We will take a deeper look into these later in the video, but Livongo uses smart devices to connect to the cloud in combination with patients' smartphones and AI to give personalized suggestions to patients on how to better take care of their condition. This approach has been shown to be drastically more effective than the traditional 3 to 6 month check-in model, and I would expect strong demand for Livongo services to drive major growth going forward over the long term. Overall, Teladoc's core offering is the convenience and simplicity that can be derived from seeing a doctor anytime, anywhere, and on your schedule. As the march of digitalization continues, I would expect the use of these services to increase as people become more aware of their availability and more familiar with using them. Teladoc is in the pole position to take advantage of this shift to telehealth. Now let's take a deeper look into Teladoc's telemedicine business. The future of healthcare is virtual. Now, of course, it's not going to be fully virtual. You can't stitch up a wound or reset a broken arm virtually. However, doctors are a scarce resource, and telehealth allows them to leverage their time and the patient's time better. This is an old statistic, but Teladoc can still refer 1% of telehealth visitors to the emergency room and 6% to primary care. But this still means that as of 2019, 92% of issues were resolved after their first visit, which saved their patients significant time as they did not have to commute to the hospital and wait for an appointment or go into the emergency room. And like I said earlier, when physicians join the network, it allows them to better utilize their time that might otherwise be spent idle. For reference, as of 2019, Teladoc is paid about $40 per visit, of which they can pay out $25 to the physician. Teladoc will drive better utilization of their healthcare network and ultimately broaden availability and lower prices by increasing supply. It also is, of course, much more convenient for consumers who can get help from a doctor anywhere that has an internet connection, and they are also not limited to getting care only from doctors in their immediate area, but can get care from doctors anywhere else in their state or province. Moving on to Livongo, which Teladoc acquired in 2020 for $18.5 billion in cash and stock, and this acquisition in particular and its integration is what really makes Teladoc an exciting company going forward. For what Livongo does, they provide personalized chronic healthcare services. For the most part, they do this by providing internet-connected monitoring devices to customers who then take readings with these machines daily. Livongo then uses this data to provide what they call nudges to their users to help them improve their health and better handle their situation. This has a lot of advantages over the traditional way of dealing with diabetes or hypertension, where patients only see their doctor and get recommendations every 3 to 6 months. In this situation, doctors are only getting a snapshot or a one-day look into their health and providing recommendations based off that. Livongo is using AI and mass data collection to provide daily recommendations to help patients improve their condition. And Livongo's strategy works, as it is shown in this data. They currently have 4 chronic care services for diabetes, hypertension, weight management, and behavioral health. Patients in each of these programs show a meaningful improvement after using Livongo. This acquisition gets even more interesting after you start to think about the benefits that can be further had by integrating Teladoc's original on-demand telehealth services into Livongo to provide an even greater level of care to their patients. Teladoc has had many acquisitions over the years, which many times I am not a fan of. However, Teladoc is an exception. Each of these acquisitions is focused into an area that they want to enter, and the acquisition allows them to enter this space meaningfully quicker. And while I do wish that they could still have built all of this they are still growing both organically and with targeted acquisitions, and this is the most important factor. Some of their other other acquisitions that I thought were most important include InTouch Health, which was acquired in early 2020 as well, for $600 million in cash and stock. They had $80 million in 2019 revenue and provide a software suite to manage care, as well as a wide variety of robots to help facilitate that care. The link is in the description to the website, along with all the other resources that were used in the making of this video. Another important acquisition was Better Doctors back in 2017, and this especially helped them build out their network of telehealth specialists. Other acquisitions include BetterHelp, which aided in their move into the virtual mental health care space, as well as Medicine Direct, a French company, which helps their international growth ambitions. Now let's transition to talking about their total market opportunity. Healthcare is an absolutely massive market just in the United States alone, accounting for 17.7% of GDP in 2019, which is $3.8 trillion in total, or about $11,500 a person in 2019. This is a massive market, and clearly not all of this will ever be addressable by Teladoc. However, an increasing proportion of this will become potentially addressable as Teladoc moves into more personalized healthcare. The United States has some of the most expensive health insurance in the world. Teladoc has ambitions to help change that paradigm by making better healthcare more available to more people by optimizing physicians' time. This is a noble mission, but one that will also accrue massive value to shareholders if they are successful. These next two slides are directly from Teladoc's presentation at the JP Morgan Healthcare Conference from earlier this year. The first slide shows how much space Teladoc has to expand just in the United States alone. They estimate that they have room to expand their telehealth services to another 65 million users at current Teladoc clients alone in the United States, and an additional 182 million potential members total. They also estimate massive expansion white space for Livongo. Out of the total 70 million people in the US with diabetes or hypertension, only 500,000 were signed up for Livongo as of Q3 2020. There are an additional 18 million potential Livongo enrollees that are already current Teladoc clients, which in itself leaves plenty of room for Livongo to double its business many times over before having to tap the roughly 52 million people with diabetes or hypertension, which are not yet Teladoc customers. This next slide shows the potential for Teladoc's expansion by just cross-selling more products into existing customers. I won't dive too deep because I think this slide is pretty self-explanatory, but Teladoc has shown dramatic growth in 2 and 3 plus product customers from 2017 to 2020, and I would only expect this trend to continue as they incorporate Livongo deeper into the fold. Let's talk a little bit about management for a moment. Teladoc's CEO is Jason Gorvic, and if you have seen any of my other videos, then you know I love an owner-operator-founder. However, Jason is not this. However, he has been CEO since 2009, so he knows the business inside and out and has been operating the company through their entire time as a public company. He is a clear communicator and says all the right things. However, I'm not totally sold on him yet, but I do think he is a good steward for the business that is in as good of a position as Teladoc is. While we are on this slide, let's talk a little bit about ARK's ownership stake in Teladoc. ARK has been loading up the boat on Teladoc during the recent pullback, and it is currently their second biggest position after Tesla in total from all their funds, as they own $1.2 billion stake, which amounts to about 5.6% of the company. Teladoc makes up a top 5 position in ARK-K, ARK-G, and ARK-W, and is also held in ARK-F. While I would never own something just because somebody else does, it does help raise my conviction given ARK's heavy investment, especially because they were buying so heavy so recently. Now let's move on to the risk for a moment, as there are with all companies. Teladoc has 2 types of risk from competition, in my opinion, and the first of which is dedicated competitors that are able to dislodge Teladoc from its market leadership position. I find this risk of lesser size than the risk that they are threatened by some big tech company taking a bite out of their market share. Amazon has shown interest in telehealth especially, as they seem to turn every expense line of theirs into a business at some point. I would not be surprised to see them make an entrance here as well. Another less talked about threat is big tech platform companies like Apple and Google. They are both showing interest in the healthcare space through various ventures, and they have massive platforms and, more importantly, millions of connected devices already collecting biometric data as I speak. With enough focus, Apple with iOS and Google with Android could create a telehealth platform that's native to their devices and take advantage of the collection of the data on these devices that are already connected to the internet and develop a compelling offering. However, I think the chances of this threat really inhibiting Teladoc are relatively low, as it would take a lot of focus to set up a similar network with as much utility as Teladoc, and if anything, they may pay Teladoc to distribute their network on their platform. Another thing to keep in mind here is that this is a huge market and there will be more than enough room for multiple telehealth companies. Another risk, as there always is with high valuation companies, is execution risk. They need to maintain and grow their leadership position in the telehealth space to continue to justify their current lofty valuation, although this risk has been decreased recently as the multiple has contracted significantly on Teladoc stock. The second to last risk is not the biggest, but there is some risks that come with all these acquisitions that Teladoc is a part of. These are complex transactions that could go wrong in any number of ways, from cultures clashing and not being compatible, to newly announced deals not being liked by investors, causing short-term stock pain. Finally, they are expected to lose money for the foreseeable future, and while they do have a considerable amount of cash on the balance sheet, it is a risk if they can't figure out how to flip the switch to profitability eventually. Now, let's take a quick look at their financials before moving on to some revenue projections. They have a current market capitalization of around $21 billion, which is down over 50% from their all-time highs that they hit in February. In 2020, their business really took off as their revenue grew almost 100% year over year and cracked $1 billion in sales for the first time. Teladoc had a GAAP gross margin in 2020 of 63%. For 2021, they are projecting revenue to grow to about $2 billion. However, some of that growth is coming from last year's acquisitions. Teladoc's organic growth will be in the 60 to 70% range, which is still extremely fast growth. They do project fairly modest visit growth year over year of about 22%. However, this is a tough comp as so much went virtual last year with COVID, and they have stated they are not projecting a harsh flu season, although that could play out and become a boost to visit numbers. They are also projecting even slower growth in member count, and this is partially due to a less mature pipeline that will start to pay dividends further down the line. And while GAAP EBITDA is still projected to be a loss, adjusted EBITDA is projected to be positive, around $250 million. Onto their balance sheet, which I would categorize as suboptimal at best, with $1.4 billion in debt and only about $800 million in cash and short-term investments. However, most of this debt is convertible to shares and comes at a very low interest rate, so I don't mind the cash to debt ratio being out of balance as much. If what I at all expect happens between now and 2027, this debt will be long gone and converted. Finally, the most intriguing thing about Teladoc is their stated long-term growth rate through 2023 of 30 to 40% on a compound annual basis. While this is a good growth rate, I think they have a chance to exceed it in the next few years and keep up this type of growth for much longer than analysts are expecting due to the sheer size of the market and the shift to telemedicine. Teladoc's valuation has come down significantly as the stock has been cut in half since February. At the current share price as of recording of $139, they are down 54% from their highs, and the drops have only worsened the last week until the bounce on Friday. This leaves Teladoc trading for roughly 16 times trailing 12-month sales, and because of their fast growth, this will come down to trading for roughly 10 times trailing 12-month sales by the end of this year, assuming that they meet their guidance of about $2 billion in revenue. I think Teladoc will, in the long term, earn a high revenue multiple for a few reasons, the first of which being because their gross margins are so high. They also have a lot of growth going forward and a huge market to go after, and this will result in the multiple being elevated for a prolonged period of time as well. We'll talk more about this later, but being a data collecting machine may also allow them to get into more specialized, higher value markets that will not only contribute to revenue growth, but also further differentiate their business and earn them a higher multiple, as well as grow their total market size potential. Teladoc is a high growth company with a huge market and great margins, and I think they will deserve a high multiple going forward. Now let's look at some rough estimates for long-term revenue growth going forward for Teladoc, just to get a sense of how they're valued now. By the way, these are not investment advice in any way and are just some numbers that I think represent relatively reasonable growth and will help us understand Teladoc better. However, I will admit that these are pretty aggressive growth numbers and will require a lot of things to go right, but I don't necessarily think that they are unreasonable. Starting with their guided sales for about $2 billion in 2021 revenue, I used their guidance of 30-40% compound annual growth rate to project out to 2023 and then slowly taper the annual growth to 18% in 2031. If you run the numbers, Teladoc's sales come out to about $21.5 billion in 2031. Let's take a look now at the valuation that these sales could imply for Teladoc before talking about one last key upside and wrapping up this video. The average software as a service business could easily trade in the 20 times sales range. And while Teladoc isn't exactly a SaaS business, and while their margins will be a bit lower, but given the enormous market, I think that Teladoc has a chance to earn a multiple possibly this high. If so, the reward for investing today would be enormous, as Teladoc would be about a 20x from where we are today. As you can see, as the multiples contract, obviously the overall return contracts as well. As for some very rough projections based off profit, I took a range of profit margins above and below 30% and assigned PE ratios above and below 30, as I think these are reasonable numbers. As you can see, these valuations are on average much lower, but I think Teladoc will earn a higher PE ratio as they will be a dominant player in this growing market. The average of all of these projections would still yield a $260 billion valuation, which would obviously be a huge return for anyone getting in today at a $21 billion valuation. I don't think I've stretched these numbers out too much, and I still get a 10x in 10 years, and these are the type of companies I like to invest in. Finally, let's talk a bit about the hidden upside that I see the potential for in Teladoc. And it has a lot to do with Livongo as well, and the confluence of AI, big data, and genomics into Teladoc. As we discussed earlier, the current healthcare model checks in every few months to see how you're doing, which only allows doctors to provide feedback based off one day of data. Teladoc can use their technology platform, particularly with the Livongo acquisition, to collect vast amounts of data and always be improving their suggestions to their customers. They can collect this data because they have a standalone product that is useful enough for customers to pay for on their own. This is similar to how Tesla is going to make their way to full self-driving because they made a product that is an excellent standalone product that consumers consumers are willing to pay for on its own, and it allows Tesla to collect data as it's using its cars as a Trojan horse. The Teladoc and Livongo combination are different because the main appeal of the product is that it makes successful suggestions which need data. However, they have already reached that threshold. Now that we know that Teladoc will have plenty of personalized, specific, and highly useful data, I want to see them incorporate genetics into their platform. As the cost of sequencing comes down, take the genome of every user as they onboard, and then use this data in combination with AI to provide even more personalized nudges. They could then use this information to identify optimal treatments for different diseases based on your genetic makeup. This could obviously be a huge value unlock for Teladoc and would make it an indispensable company in the healthcare space. Finally, my conclusions. Teladoc's core offering for their telehealth business is more convenience, more availability, and less expensive care. This is a product that is without a doubt a step up for consumers and will drive adoption of telehealth for years to come. I think perhaps even more importantly, the Livongo acquisition opens up avenues not previously open to Teladoc for expansion into personalized healthcare, which is the next step in the evolution of healthcare. It opens up an avenue for the use of genomics to find its way into Teladoc's ecosystem, which would be yet another layer of value add for the company. While Teladoc will face competition, likely from big scary companies like Apple, Amazon, or Google, they have a massive total addressable market and are growing quickly into it. Now for what my plan is with Teladoc. When I started looking into this company in February, I never thought it would fall this low again, but here we are in the 130s and 140s. Teladoc currently makes up about 2% of my portfolio, and I will continue to buy more as it falls lower. My cost basis is currently in the 170s, and so I'm down around 20%, but it only gives me a better chance to buy more now while the price is depressed. The last thing I'll say about Teladoc is this is a much less speculative company than others I've covered on the channel, like Beam, Latch, or PacBio, and I can therefore make it into a much larger position for the long term. Thanks for watching. What do you think of Teladoc? Where am I off in my assessment, and what's your price target? Let me know in the comments below. Don't forget to like and subscribe. It really helps out the channel. My goal is to get to 1,000 subscribers by June 1st, and I'd love to have you along for the ride. Thanks again for watching, and have a great rest of your day.